Good morning, everybody. Welcome to Tuesday. I hope you're all doing well. Morning, Stel. Morning, Kay.
Morning, guys. Hello.
Good morning, guys. Good morning, everybody.
How are we doing, everybody?
All good.
All good?
All good. And you?
Yeah, not too bad. Not too bad. A bit tired this week for some reason. Don't know why.
But, at least it's Friday. No, wait.
Yeah. must be the end of summer. We're in October. That summer gone now. I'm probably depressed and never going to see the sun for another 6 months now. You're probably still on the beach, mate.
Yeah, mate, it's still summer here. Seriously.
Bloody
but not for long though. Another week or so, and then it gets cold, like 20 Celsius.
Yeah, freezing, mate. You have to put your t-shirt on. Let's get stuck into it. Not a huge amount headline-wise. We had a few central bankers waffling on yesterday. Nothing real of note. BOE's man said that tightening abroad has led to added inflation in the UK. Half a point there by her, because obviously the level of sterling has put pressure on inflation, as a currency can do if it drops too far too fast. Bit of data that we had overnight from Tokyo CPI, another heavy reading there. Year on year, 2.8 versus 2.9. Core 2.8 versus 2.6 prior. It was expected at 2.8, still confirming 2 pips up. So just another country that's seeing a little bit of a differential between the headline number and the core number. Headline dropping back a pip, but the core rising. And this is a theme we're seeing across a lot of countries at the moment. But in the main, we're seeing that number still up towards 3%, more than 2%. Are the Bank of Japan going to twitch on that? Unlikely. This is just one regional number, or the main city number. But the national CPI is doing pretty similar. No real reaction to the yen on that. As we know, the Bank of Japan are going to keep ploughing ahead. They still see inflation falling back, still seeing it being affected by temporary factors. The point, as I always make and have made through the Fed and everyone else, is those temporary factors may be okay, but it's how long CPI lasts, or how long does temporary last for, and then how long do we see the domestic side of things, i.e. the core inflation, picking up on what's happening in the main headline number. So that's what we need to watch there for those guys anyway. The RBA, with a bit of a surprise last night, only hiking 25 pips, and that's caused a bit of a ripple in markets this morning. As you can see there in the yield space, yields continuing to dip. That's the US 10s, but the picture's pretty similar, as you can see from the rates on the right-hand side of the screen there. Now, a few things here. The reasoning behind the RBA going lesser. They didn't really specify exactly why they only went with 25 pips, but looking through their GUMP and the statement from the governor, they are still seeing a tight labour market, and they expect unemployment rate to be hit further down the line. So they're still seeing plenty of vacancies, still seeing good jobs growth, still seeing wages on the rise. But one of the reasons potentially why they've gone a lesser hike is that they're seeing higher rates putting pressures on household budgets. Although, and maybe another bit of warning, they haven't yet, as far as they're concerned, seen the full effects that's been felt on mortgage payments due to higher rates. I've got a half a feeling that they've been scared by what's happened in the UK, in terms of if yields start spiking and the problems it can cause in various parts of the economy, as we've seen with the UK in the pension sector. A lot of the market is now going to start bringing back the old pivot line, and I think how that's hit yields today is the market saying, okay, well, if the RBA is slowing down, we know the RBNZ are slowing down, is this going to translate into the Fed slowing down? Now, we know at the moment they're not slowing down we know the Fed have said at some point they will have to slow down. What we need to watch from here is if that language on slowing down rate hikes gathers pace, if it changes to become a bit more on a timeline, so we get to hear, well, you know, maybe by March we'll have slowed down, or maybe by January, you know, that sort of thing. But we've seen all through this hike cycle of the Fed, there's some in the market who continually try and push or try and trade a pivot in the Fed. The problem we have at the moment is, and this has been going on for several years now, there's no middle ground anymore in markets. It's one extreme or the other. Either we're hawkish or we're dovish. There's no sitting in the middle. And that's a problem because, you know, you don't see yields coming off 50 pips in a few days in something like US 10s. You don't see them moving 70, 80 pips in UK gilts. These are extreme moves. And we're getting this partly because of expectations on the hawkish side, and then the reverse happens, and then we get something that gives it a dovish shock, or the market, some in the market gives it a dovish slant. So I think the RBA have added a bit of fuel to the fire of these guys who want to see a Fed pivot. Is that going to come? It's going to come at some point. Whether that's going to be 3, 6, 9, 12 months, we don't yet know. But for now, I don't expect the Fed to change their view of things. If they do, it will be a bit of a shock. And that's what we've got to deal with. So where can yields go here? You know, is it going to be a one-way trip down, undoing all the rally we've seen since August? I'm not so sure. Rates are still expected to go higher. We're still looking at this 4 to 5% area for the Fed. Same for the Bank of England. The ECB, they're 2.25, 2.5 area. I don't see why they would stop, but we are getting a shift in expectations. Now the market probabilities of pricing the next expectations for the RBA are not whether it's going to be 25 or 50. It's now whether it's going to be 25 or 0 or unchanged. And that's what we're going to be dealing with moving forward. Now, a few people in our chat room have asked, particularly of a couple of currencies, why haven't things like the Aussie or the Kiwi, or why have they risen when effectively the central banks are slowing down? To understand that, you've got to understand what's been happening all the while back. And I don't want to take too long to go over that, but just to make a little point, and I'll bring the other guys in. None of this, or a huge amount of this, has not been about what other central banks have been doing. Look at the Aussie dollar, look at the Kiwi, look at the pound, look at the euro. All those countries are hiking, and yet all those currencies have fallen. It's all to do with the Fed. The Fed are the #1 game in town. So if you want to trade rate differentials, we're going to have to do that when everybody's got their rates to where they want to be. Because at the moment, if the Fed hikes 75 pips, that's going to swamp the RBA hiking 25, 50, 75, because that's what we've seen for the last few months. So the Fed is really the only game in town. So until they get to a point where they're happy and rates are going to pause and everyone else gets to where they're going to pause rates, it's really only going to be what the dollar does. Yes, we're going to get little gyrations in between, but the larger picture, the wider moves are still going to be on what the Fed does. And that's what is driving currencies at the moment. Once everyone gets their rates to where they want to get them to, then we can start trading rate differentials. You know, who's going to start coming back down to neutral first, whose economy is going to start doing worse first, who's got a bigger recession, who's got a small recession, who's not in recession. Then we start trading around the rate differentials. But until we get to some sort of neutral area where everyone's on the same level pegging or rates have paused, we're really only going to be trading the dollar in the main. Guys, I've not a lot of comments. I don't know if you've got any other headlines you want to throw up. Obviously, one bit of data, Eurozone PPI up higher. No, not unexpected there. You got any other lines and bits of news you want to throw up?
I personally don't have any news or any data that you missed or anything, but what I just wanted to add my 2 cents on what you said about central banks, about the RBA. I think we are seeing a slight shift by central banks, and I think it's going to Sorry, I'm just moving to another room. I think it's going to continue. We saw the Bank of England first, as you said, on the whole pension panic. They're going to be doing. They're going to be buying with. Well, they are buying gilts again, and the RBA doing 25 instead of 50. I think we're getting to the point where this shift is slowly happening. And I've said this before. Remember, even when some weeks ago the Fed was just full speed ahead, everybody was tightening, and I said, look, I think if things go get hairy, then I think the central banks are going to step in, and I think it's going to be much sooner than people or markets expect. So I just want to reinforce my feeling that I think things are changing slowly. I don't think the macro environment has changed yet. We're seeing a rally in risk, and we're going to talk about levels and stuff. But I think this is still a bear market rally. But I think the time for the big change is coming, and when that comes, there's only one way I want to be, and that's long. So, I think we're getting there slowly. We're not there yet. I don't think, all these people who are quick to say, yes, this is peak inflation, peak everything, buy everything. I don't think we're there yet, but we're getting closer.
Yeah, I make you right. And I think it's also going to be a case of how bad recessions are, how bad soft landings are. Are they soft or are they crash landings? That's still
Also in the US, we're seeing leading indicators which are really missing now. You saw PMI yesterday, services PMI. No, what was it?
ISM.
ISM, yeah. We saw ISM, and I mean, every part of that was bad. Employment, new orders, the headline, prices, everything was bad, and it's really not looking good. And it was in contractionary levels, a big miss. So all this is going to feed to the economy. It just takes a few months, but it does feed through. So we're now seeing the lagging indicators still doing well. Inflation still high, employment still relatively okay, but the leading stuff is not good.
It's going to make the NFP interesting if that comes in a bad number.
Oh yes, yes. Yes, mate.
Kay, what do you make of it all, mate?
Well, you guys said everything already. I don't have much to add. Only that I think that RBA wants to preserve their economy going. They know probably that if they hike a lot, they may drive their economy into a recession. So perhaps that's one of the reasons why they did only 25. Looking around, also seeing what's happening in China. That they are still on easing and liquidity injection path. Perhaps they want to keep a little bit of ammunition in the box just in case China does something funny. I was going to say ISM is starting to be volatile. Last month we had a positive surprise, and this month we have a negative surprise. So the bond market is reacting wildly. I've been talking about this 4% in the US 10 years for weeks, and we rejected it quite severely. Now we are starting to go the other way around. But for once, I would not like to be a bond trader on any of the bond market desks. They must have pulled out all their hairs lately. It's really wild. This 2020's decennium is starting to turn out to something really special, really wild. I've never seen this repricing in my whole career, where you do like 30, 40, 50 points on US 10s just in the blink of an eye. It's quite wild. And the market reacts to it. Sooner or later, and we all knew that, sooner or later those data are going to turn around. You cannot hike rates in a buoyant but we know fragile economic recovery as well. There are still issues in the supplies. China is still in COVID lockdowns in a way. We knew that those things will be coming, and now everybody is acting as if they're surprised. Now, is it a turn? I don't know yet. I'm in the same camp as Stelios. It will turn at one stage, but are we there yet? I don't know. We have seen surprises, but the employment index being so weak in the ISM might tell us that we have to be a little cautious going into the NFP at the end of this week, and then into CPI next week. Every major data point is now going to be a major event as well, just because of the markets being so fickle and repricing everything. I don't like the word repricing, but going from one side of the boat to the other in the blink of an eye, it's a bit of a strange one. Testifies as well that they don't know either. Otherwise, the bond market would be more quiet. It's interesting times, and personally, I think the market is going to continue to play this kind of ping pong and yo-yo for a while.
Yeah, I don't know what it is with I don't know if it's a type of trader or the way things are set now, but you know, we never used to get these extreme swings. You know, things would move subtly between one end of the scale to the other, between hawkish and dovish, and over time, but it is just a complete. You come in one day and yields are breaking new highs. You know, 3 days later, it's going the other way. It's bonkers. Sorry, mate, you saying something?
Indeed, we haven't seen that, and it testifies to me that the market doesn't really know what to make of it right here and now. So I think we may be in for a bit more of all this. We have seen big swings in the past when you end cycles. You see big swings. You do see them. We have seen those kind of swings, but you don't see them one way and then the other, and then up and down again in the space of days. That's something new to everybody.
Yeah, exactly. And that what I'm showing on the screen now is US interest rates, and I think that's a big issue behind it. You can't hike rates that fast, that high, and not expect to get any fallout. And I think this is something that's going to bite the Fed in the arse at some point over the next few months. You know, you look at when we came out of the banking crisis. Took what? Let's have a look at that. December 15, we got to the high rate in 2019. You know, you can't. That's a slow and steady hike path, and we've blasted that out the water.
Isn't it amazing? If they had just stopped denying inflation by saying it's transitory, you know, 9 months earlier or a year earlier, and do the same amount of hikes at half the pace, I mean, that would have been great, I think. But no.
Yeah, exactly. That's exactly the point. You know, let's see if my drawing skills are right. If they'd have done maybe from 2021, you know, they could have done something like that much earlier, much shallower, similar pattern to before, and we wouldn't have had all these problems. But they got their arses spanked, and now they're playing catch up, as we know, and it's all about credibility. But yeah, this is going to bite them in the arse at some point. The way inflation bit them in the arse when they said it was none, and that's going to cause greater swings and higher volatility, which, if it's the right type of volatility, is perfect for our trading. So. You know, let's hope that happen.
One thing that I would like to add, though, is that I saw overnight, and that came out in the Wall Street Journal. I was quite baffled seeing this. Is that an agency of the United Nations calling on the Fed and other central banks to halt interest rate increases because the economies. It's going to reduce poor countries' economic output and harm the global economy. So now even United Nations is getting involved in monetary policy.
Yeah,
that's a new one for me too.
That's now you know we're in crazy land when you get the UN commenting on economic policy. Now that's the sort of stuff the IMF try out.
Maybe they're just long bonds. You never know, right?
Yeah, probably. That's where they get all their financing from. Okay, well let's get into some of the price moves. Not that there's been a huge amount going on. Let me get back onto my FX page. Boom. So the quid, still plenty of vol in this at the moment. Had a strong bounce up to 114, running into trouble in some of the prior support points that we've had in here recently. That area also goes back to 2020 there, where we had that, call it the COVID lows, if you like. So that is a bit of a traffic area, just based on the previous action around there. So we're seeing some resistance up into the 1440s. So this could be a bit of a line here. If we go back above there, then we're potentially 115s, maybe even higher, maybe crawling back up to the 118, somewhere like that. Still very volatile in the quid. We're swinging around very fast. We got some shenanigans just before the show started. Apparently Bloomberg rehashed the Guardian story from last week about an emergency meeting of Liz Truss and the OBR. That sent cable down good 40-50 pips before that got retracted as an old story. So you can see the volatility we've got in the pairs at the moment. Let's go into a shorter term chart. I'm still not really trading cable. It's still a bit too volatile for my liking, so I'm leaving it alone for now. I've not got too much tech involved because at the moment a lot of the tech isn't standing up to much. So I'm keeping it pretty simple to prior support resistance areas and seeing how the price reacts there. Euro sterling is a lower, well, you could say a lower volatility pair to play. You wouldn't have guessed it of late, having just done a nice 400 pip round trip. But here we are again, you know, coming back to the old levels that have been in play. We're down to this zone that I've had on my chart for ages and ages. Holding now below this 87 area, which I tried a little long yesterday off of that or into that just to see if it would hold. Technically it hasn't, so I'm out of that. Only a small trade, that was out yesterday. Holding below this point at the moment, so a bit of a question mark now. Do we sort of ping pong between sort of 87, 87.20 and the mid to low 86s? Obviously we've got a lot of stuff coming out from the UK still, this OBR stuff, the budget, how they're going to cost it, what the OBR is going to do. As far as the Bank of England concerned and the pension situation, they only bought 22 million in bonds yesterday. That was versus 1.1, I think 1.1, 1.2 billion the day before. So vastly lower on that. They have reiterated they're going to keep the operation going until the 14th of October, but 22 million, if that continues along those sort of numbers, it seems like this leak has been plugged, the plaster has been put over the hole, and we can all move on from that. The only other pair I'm really looking at right now is dollar yen. I'm based on everything we've been saying, and as Stell mentioned, you know, it's going to come a time when rates are going to hit the tops, wherever that may be. And my own thoughts that it's really going to take something more hawkish than what we have now from the Fed to see the dollar rising significantly. I'm getting a bit of an itch to be short dollar yen. I've already scratched that itch with a really beer pips trade this morning. I'm short at 144.74, just so I've got something on the table. I haven't got huge conviction for the trade at the moment, but I am looking to build a short position. At the moment, I'm going to keep it very small. I won't even risk, I don't think, 1%. I'll sell it maybe up to 148 to 150s. If it goes up there, I'll assess why we're going up there. But I just feel like I need to be short some dollars. And this, to me, is one of the pairs that could move if we get a real turnaround from the Fed, from the data, from the market itself. This is the one that's rallied, obviously, massively of late. Obviously, the Bank of Japan and what they're doing over there is a big factor why we're still holding up and why the yen is still weak. But even there, I think at some point the Bank of Japan may be forced to change their tack slightly if we continue to see the data going the way it is at the moment. But yeah, I haven't got a great conviction here as I did when I bought it a few years ago, down towards the the low 100s when I thought inflation was going to start appearing. But I have got an itch. I need to scratch it. Kay, what's your thoughts on dollar yen? It seems to be holding up quite well given what's happening in yields and everything else.
It does look to be in a world of its own, right? We're trading yen crosses. Now, yesterday, the market is probably taking this rally in risk, rally in commodities, rally in oil as an excuse to keep the yen weak. But then on the other side, one of the main reasons why dollar yen was up here were the US 10s, and they came down nearly 50 BPs from their highs, and dollar yen is still holding here. So to me, it's I must admit, it's a little bit of a mystery right here and now. And for as long as it holds here, I've been saying it a couple of times, and it's short term, but it could become a long-term interesting level. Is just below that 144 now. The last times we tried down there, it was bid really well every time, 143.90 figure. And that's the one that I'm going to be looking at. As long as we're above there, I'm not sure that I really want to be short dollar yen. The problem is, if you're short dollar yen and you hold it for long, your funding is going to bite, right?
Yeah, exactly.
It's going to cost you to be short dollar yen. Yeah, I see what Mike is saying, but Mike, I mean, if risk on is dollar yen up right now, then the correlations have changed already, because that correlation went out of the window the 1st of April this year. We have not been trading risk on, risk off dollar yen for at least 5 or 6 months. Okay, the correlation can come back from one day to another, which it may have been because all the yen crosses are higher. But the correlation with risk on, risk off in dollar yen hasn't worked for 5 months, because the dollar yen was still going higher when the equity markets hit their top, and equity markets came down. Let's not forget, from 4,600, S&P from 4,600 to 3,600, and dollar yen was still ramping higher. So that doesn't work. And oil has collapsed, what, $40 from the highs, Japan being an importer, and it didn't work in the end. So I think the correlation, as I said, it can come back any day, and it might be that we are now back on it, but it needs to be confirmed, right? And I still want to see the confirmation. I'm not going to make an assumption on 24 hours to say that such a big correlation is coming back, whether on yes or no. So, but for the time being, yeah, I'm very, very, very undecided on the dollar yen as such.
Yeah. I mean, there's no denying what the trend is, and there's every chance it can go higher. But in my mind, the longer it doesn't go higher, the greater likelihood that perhaps we have found a top, or at least a consolidation phase. And that consolidation phase can be 200-300 pips. So we need to watch it. But I'm getting a bit of a twitch to be on the short side. So I've just dipped my little toe in. Just so I've got a bit of exposure on that, and it stops me with the FOMO, which is obviously a big thing for a lot of traders. Now, gold I want to look at, and we were looking at this, I was looking at this area, we're back above this break point at the moment. Now, a lot of people were waiting for this move to happen, wanting to be long gold, and they're justified, but for me, gold isn't leading anything at the moment. And I showed this chart yesterday, and I'll just show you quickly now. You can see what's leading gold at the moment. That's the US 10s in the orange line there. So very much a yield follower, a dollar follower, which is nothing new, but we're talking about correlations and what's driving what. The yields are really driving gold at the moment. Gold isn't up because of a risk play, safety play, anything like that. It's purely following the yield story, and that is very evident if you look at that chart there. So I was loath to try the short into the area. I left it alone. I didn't like the move. I didn't like the reason why it was moving. I'm not keen that it's moved this high. I'm not saying it's going to turn into a sudden bull rally. or undo a lot of this move up to 2000s or whatever. But it's not leading anything, and I think that's the important thing to look at here. So if you're long gold and you see yield suddenly turn up again, you're going to need to watch out your positions, because that's likely to mean that gold drops back a bit. Kay, do you want to take the screen?
Yes, sure. Stella, are you still around? He's still here.
I am here, yes.
Yeah, okay, mate. The first thing I'm going to do is to I'm going to jump on yields for a second. Then I want to have a chat about the silver. Okay.
Yeah. I thought you never ask.
Mate, I'm your mate. You don't forget it. I'm your mate. I mean, I'm always talking about stuff that interests you and me. So first of all, 10-year yields. So we had the 4%, the rejection. We had a first support here around coming in around 375, broken down, and that's where really the dollar reacted the most, when these 3/3 broke. So now we are back onto the next little channel support here, in my opinion, around this 358. We're right on it, but we shouldn't exclude anything. We can get back down to 350 before even NFPs come out. But if we start to hold here and we don't get a bad number, let's call it a bad one. I think what's the expectations? Let me quickly have a look at what the expectations will be. It's a bit early, but I think they are going to be decisive for this this interest rate move now. So people are expecting 250K. So anything which is 200 or above will be seen as a positive number, in my opinion. So so this is a first interesting area, and then of course around the 350. But what's funny, well, up to now at least, is that the 310s have rejected pretty severely. I mean, this is a big move. If you have bonds in your books as a professional, the asset managers and stuff, this is 40 BPs in the 10 years. I mean, people, it seems like the Reddit community, people don't realize, if you're sitting outside of the market really, and you don't have any bond portfolios as a professional, the people don't realize how big a 40 BPs move is. But you traded rates, right? Still,
I have traded rates, yes. Used to market make
10 years dollars is a big move, right?
Yeah, absolutely. Obviously, it depends on the general prevailing circumstances, but yeah, it is a big move. Yeah.
Yeah,
the bond market was always the elder statesman of markets. Calm, collected, not a lot of huge volatility. Back in the day,
Yeah.
FX was the bonkers market, and it's done a 180. Now everyone in the bond market's running over their pants.
I tell you what, when I was market making at Merrill Lynch, our team was basically us, the swaps traders and the bond traders and some FX guys. And the bond traders had the lowest volatility of P&L of everything. I mean, they were consistent, but very, very low volatility. They were like the cash cows, and the big hitters were some of the swaps guys who, they carried huge positions. But still, yeah, the bond markets, such a move is considered a pretty big move. I mean, it is, yeah.
It is. So, and I wanted to show a little difference here. Even though we did the same amplitude of move relative to the 10-year, we know the short end of the curve is usually quite a bit more volatile, because we've got a lot more hedging going on in the short end of the curve. We've got a lot more just like activity in the short end. So a lot more people are involved in whatever they need to do for whatever reasons. Just wanted to show that this is still, for now, but it's still holding the 4%. Been a prior top, it's been a bit of a jump off area to go to the high. So keep an eye on this one. I'd say if this goes back below 4%, we could be trading down to 380. If it goes back below 4% like this afternoon, or into the NFPs, there may be a bit more shenanigans, or a bit more dollar weakness into ahead of the NFPs, I wanted to say. So that's one thing I wanted to show you. So for as long as this holds, I'm not sure if the dollar is going to weaken materially further, and then the 357, 358. Well, gold is a quick one. I think there's a bit of a trend line resistance coming in around 1715, and then if that goes, we're talking again about that area, a big traffic zone around 2028. But more than gold, I wanted to talk about silver with Stel. And first of all, I'm going to go into the short side, really the 1 hour chart. So we had this end of month, end of quarter stuff where we had a lot of rebalancing of assets, and we saw that's when the US 10s really accelerated to the downside. That's where the dollar got sold, where the euro and the sterling got heavily bought on rebalancing needs. So we had about a similar move in the metals, and that's where both gold and silver rallied. But then yesterday, and then here, this is around noon our time, and silver all of a sudden took off on its own.
Yeah.
And I don't. Okay, we can see some technical levels, and if we were talking about these 1940s in the past, 1960s, and technical level, and you're flying through, but it went well before the ISM came out. Do you have any sensible explanation to explain this?
I don't really know, not for this particular move. I mean, the thing is, silver had been underperforming quite a lot gold. You so look at the gold-silver ratio, it had been going up quite dramatically. So when things start rallying in metals, you can expect the silver outperforms. But man, that move, 8.5%, I didn't expect that. We've been talking about COMEX inventories, LBMA inventories being depleted, and people are following it quite a bit. Now, I did notice that a particular hashtag was trending #1 on Twitter yesterday, which was silver squeeze. So when you get all these people looking at that, you get the Reddit brigade coming in. It could be a combination of all these things. I really don't know, but
okay.
It was a crazy move.
I found it quite spectacular that right at that time, this is because this is GMT, okay? So this is right at the 12 o'clock bells in London, the thing took off. And quite dramatically. So, okay, here then we have the acceleration on the ISM data with the yields coming off further, but I found it really spectacular. So I was wondering if I really missed something, a news or so. And I'm still keeping my long term, but I'm starting to have a feeling that I may have missed that something around here to really add to the long term and just stick it away, because as we were saying earlier on the show, we might be seeing the sort of the start of the start of the end, which is always difficult and dangerous to call, but this move is pretty impulsive in my opinion. So this morning, then coming back to the actual price action, we stopped dead on this trend line. We know from the past that this 21 zone is a bit of a traffic island. It's a crossroad for silver. So I bear that in mind. Look at this 21 level. I'm not going to chase it into the NFPs especially, but if I see moves coming back down to perhaps lower 20s around this zone, I may add back what I sold out yesterday. I still had some add-ons running from before, and I sold the best of it out yesterday around 2020 because I didn't really understand this move. But if it's a justified move, then I think anywhere low 20s now should be a decent area to buy. If not, around 1960. of course, we have to be very careful going into the US data. So yeah, so still, while you're still there,
Yep.
was this it around here? 17.5, 18.5. Was this it? Have you seen it?
Big question. I think it was it, but it's a big question. For people who are members and look in our go in our trades room, I did post. I had a small core position from well below, and I added a little bit today, so my average is just above 20 now. And I'm going to keep adding, whether I add at the levels you mentioned, 1960 or wherever that is, or higher. In the grand scheme of things, I don't care. I really hope I add higher, above 21 if it breaks convincingly. But we'll see. I think that might be it. I really do.
Yeah.
Obviously, nobody can be sure, but I think that might be it.
You know what? I'm really starting to think the same. I'm really starting to think that this was it. We were like wondering and trying to be very cautious. We've been talking about 17, 16, whatever, but I think that may have been it. And even if we don't, how shall I say, break new ground. If you look at it a bit technically, you had like false break, and then hold in the bigger channel.
Yeah.
We could go even just back to 25, which is a big move, right? That's a 20% move.
I've said repeatedly, I think a year from now, we're going to be looking at prices, spot prices, and we're going to laugh at, 17, 18, 19 bucks silver. I think we are.
Yeah, I really think we are. We have to agree here, yeah, I'm really starting to think that was it.
The other thing which is encouraging is that gold broke above 1690. Remember, I was saying I want to see a daily close above 1690, which means that breakdown is now negated and it's a false breakdown, and that is technically very strong. There is that trend line you have there, which still has to be surpassed. It kind of coincides with the trend line on silver. So that's, I think, the last hurdle that we need to see, and NFP might give it to us today. I don't know.
This week, yeah.
Yeah.
Yeah, no, but I agree. It's as we were saying, sooner or later those data will turn, and who knows? ISM may have signaled the turn. We don't know, of course. Okay, thanks very much for that, Stel.
My pleasure. Thank you, mate. Thank you.
Your comments on precious metals, since you have like a lot of experience with those. Right, euro. We've broken above this 98.40 now. Also, I think this prior, we're in a bit of a traffic area now. 99 the figure, up to 99.10 or so. We should be monitoring that. And do we have the strength to go above? Could be, but in the bigger scheme of things, I still pleased to think that we are in a downwards creeping channel. I need to freshen up my my charts a little bit, really. But we're still in a big downward channel, and that's now actually the top side of it is not far from parity. So if ever we are continue to creep back up, and it might be the case that we are trading again around parity, right on the NFP. We have seen that in the past, that this parity was attracting a lot, and I think there's still a lot of optionality going on around parity, whatever we crossed or not. It might not be showing up in the whatever data that we are monitoring, but I still think there's a lot of people engaged around parity on the euro dollar. So why not magnet back up to there ahead of the NFP? I still can't really buy euros for the longer term, but there might be a time where we need to do that. I still think there's a lot of weight hanging around its neck due to the Ukraine situation mainly. But yeah, I mean, who will say no? So watch this 99 figure 15, I'd say, in the shorter term. The dollar yen we've done. Ryan talked about it. It's now we have a look at cable. This cable is interesting. We had this sharp drop from 117 down to the 103s, 114 and 40. Call it 114, 40, 50. There's a decent bit of resistance there. Prior low, prior high, where we tried it again here. So keep a close eye on this 114, 40, 50 if it ever goes there. I've traded it once against that level this morning. We were looking at it in the room, same time with a couple of people. So we traded it a bit on the back of it. Should be a bit of support now coming in, 113, the big figure. But I'd still, well, personally, I'm more playing ping pong and a yo-yo than anything else right now. I might make bigger decisions after the labor report if that starts to really slow down. I'm not sure whether cable will be the best instrument, but since people have been selling so much of it and then now getting stopped out, more than likely, at least the short-term players, we might see a lot of activity in here as well come the NFP, because it's really trading fast. So keep that in mind. And I think this 114, 40, 50 is an interesting one. If it goes, we might have a look back at this 117.60, 117.40. 117.60 has always been a level that I've been paying a very close eye, very close attention to. I really like that level for pivotal level on top or downside. Something else. As I was showing yesterday, Euro-NOK rejected the trend line, and now we're already back to the first support here in the 1042s. Prior top fib level. Keep an eye on that one. I wouldn't exclude, if oils continue to go higher, which they both are trying to do right now. Brent is close to $90 again. I wouldn't exclude a move to 1040 or even below. Why not get a move back down into the 1028, 1032 zone? That's all possible. But my view on the NOK, and we will have a closer look, or perhaps know more per correlation if and when the OPEC Plus make their decision on Wednesday. But my view in the NOK, and since I still haven't given up on the dollar completely, is that NOK, due to the Norges Bank compensating and seemingly compensating more than what the tax payment needs are now in Norwegian kroner buyers by the Norwegian companies, I still wouldn't rule out a last leg lower in Norwegian kroner, and it's a bit of a more medium-term view. But I'm starting to get interested in dollar NOK. These levels here, okay, I mean 1054, we came on it this morning, but more so around 1040, give it down to even 1025. This zone here, I'm starting to get really, I will get interested here to try something. I really think the dollar might not be done yet, also because of quantitative tightening still going on in the US. So we will have to look at a few combinations there. In the meantime, we have to respect this big channel. So I might be completely wrong trying to get involved here in the middle of it, and ultimately, it might be that we trade back below 10, but we will see when time comes and if it comes. So the big channel, keep it in mind, and then see what happens somewhere around here. I'm not going to look at, perhaps a quick one on the dollar rand. Because the dollar rand, despite weaker data yesterday, has really benefited from the lower dollar yields and yeah, mainly the dollar yields and the dollar setback, and then the risk on rally, the equities higher, commodities higher especially as well, and we've broken backs up this 1780 in the dollar rand, and now we are looking at this prior channel again, with support around 1760. We're trading 1773 as we speak, so keep close eye on what happens in the 1760 to 1750 zone, I'd say, if it comes down there. If it breaks back down, we could actually go all the way back down to 17, but keep a close eye on 1750, 60. And then the rest, really, not a lot is changing. We saw the rebounds in the euro crosses. Euro Mex is now also seeing a bit of a retracement. I'm just playing ping pong with it right now, with around a small core. And with that, Ryan, over to you.
Thank you very much, sir. Thank you very much. Just quickly, I just want to look at. Let's get that out there. Share the screen on stocks. There's a question in our chat room from Simon, who's a long time watcher of the show and a long time roomie. You know, are we in? Do we remain in the bad news is good for risk, or will there be a flash of bad news means it's bad, so sell off again? It's the risk on, risk off thing is another thing that just seems to change with the weather. You know, why are we seeing stocks rallying? We're seeing stocks rallying because bond yields are falling. Why are bond yields falling? Bond yields are falling because the market thinks that we're getting to the end of hikes, and that means less pressure on economies going into recession. Or it means that the market thinks we're going to hit a recession, it's going to be bad, and QE is going to come back. Either way, we're heading for a slowdown. That's been seen. Kay's highlighted it, Stell's highlighted it. We've seen it coming in the numbers. We've seen it in the US housing market for ages. We've seen it across the board. The US is in technical recession. It's coming. So I can't understand sometimes in what environment stocks rally when countries are heading into a recession. For me and my many years in this industry, it still doesn't compute in real terms, seeing moves like that. So I fully agree with Stell that, you know, this is probably a bear market rally. And again, the chickens are going to come home to roost if the economy really starts doing poorly in the US and elsewheres. How is that going to be a benefit to stocks? I just can't see it. So I think, yeah, there's another day of reckoning coming in stock markets there as well. Now, just before we end up, just want to highlight once again our Traders Summit coming up later in October. I shall put the link in there for you in the chat for those who haven't signed up yet. Real good stable of people coming into this one and speaking at the summit. Looking forward to a lot of these guys, and I'll be interviewing a few of these guys as well during the summit. So if you haven't registered already, please do so. Tickets are free. You can come along. You can pop in and out as you like. It's running Friday through Sunday, 21st, 23rd of October. So book your tickets there and come and enjoy the fun and games. As far as that goes, I'm off for the rest of the week from tomorrow. I'm heading off to Kay's hometown or home country of Belgium to follow my hapless Hammers in their European adventure for the football. I shall be tasting a few of the beverages out there, no doubt. So I'll be leaving you in the capable hands of the K-Meister and Stell, and maybe even Steve will pop in for to share his wisdom with you as well. So until then, until next week probably, have fun. Go easy on Mr. K there. Don't give him too much to talk about, anything too difficult. Trade safe. Watch out for the NFP on Friday. I hope you make lots and lots of pips. Thank you very much for coming to the show. Thanks, Kay. See you all. I'll see you on Monday. Kay will see you tomorrow.
Cheers, Ryan. Have a safe trip. Have a good day, everybody. We'll chat tomorrow.
See ya.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.